I guess you can all start talking about fundraising for funds.
Cool. So I think the idea of this discussion is that a lot of people talk about how difficult it is for startups to raise money in Europe at the moment. We're going to talk a little bit about how difficult it can be, or how funds raise money for their own funds. So I first came across this. I think a lot of startups don't know where VCs get their money. I think, first of all, we're going to shed some light on that. But before we do that, we're going to ask the guys to introduce themselves, and then we can ask some questions.
Okay, should I start?
Yeah, go.
Okay, hello everybody. My name is Nicolas de Bock. I work for Balderton Capital, which is one of the largest European Series A fund. So we are based in London, but we invest all over Europe. Hence, I'm here in Lisbon. Happy to meet great startups. So we've been around for 10 or 15 years now, and we are currently investing our sixth fund. If we want some, so our ticket size are between, I would say, 1 and 15 million. So that's a wide range. But later, when we'll talk about how VC raise fund, I'll explain you why maybe. And if you want some of our portfolio company, we're investor in Citymapper, in Vivino, so a mobile app, but also in fintech with GoCardless, with Crowdcube, in SaaS with Talent. I mean, we have a lot of companies, and let's move forward.
Cool. Boris.
Hi everyone, my name is Boris Golden. I work for a fund called Partech Ventures. We're based in San Francisco, Paris, and Berlin, and we invest basically across Silicon Valley and Europe. And we have a large range of investment ranging from really early seed, 200K ticket, to growth stage with a 40 million ticket. So it's pretty large. We've been around for quite a long time. Actually, I realized today, speaking with my fellow investor, that Partech is older than me. We were born in 1982, so it's a long time. Some famous investment we've been active in, Business Object quite a long time ago, and more recently, Dailymotion, the YouTube competitor, The Fork, or El Tenedor, and many other investments. And so we're pretty active, and we're looking forward to making our first investment in Portugal soon, I hope. And very happy to be with you guys.
Cool. And last but not least, that's the...
Hi, I'm Fausto Boni. I'm Italian national. I've created a fund called 360 Capital Partners, investing across Europe, mainly in France and Italy, but also elsewhere in Germany, UK. Tickets ranging from 200K to a few millions, 5, 6, 7. We have been around for also quite some time actually, almost 20 years now. And we look forward to look at opportunities here in Portugal. We have been looking at them in the past, and I would really much like to do something here one day.
Cool. So I'm Chris. I work at a new fund in Berlin. Prior to that, I used to work with Web Summit, a conference company where I looked after each of our investor attendees. Back in the early days of Web Summit, when we were talking to investors, a lot of guys would ask which LPs were coming to the event. And we didn't know really who these guys were. Our pitch to investor attendees was primarily the amount of startups that we had coming and the caliber of those companies. But we soon realized that a lot of investors, although they wanted to meet with startups, they were, in some cases, a lot more interested in meeting with LPs, people to fund their own funds, which kind of got us interested in kind of working out who these people were. So I think I saw Boris had some slides on SlideShare where you explained where VCs raised their money. How many people know where VCs raised their money from presently? If you have a show of hands. I assume there's a lot of entrepreneurs in the room, and I think a lot of those people would kind of get a kick, I suppose, out of seeing their VCs pitch for money too. But that's pretty much how it works, right?
Yeah, so I mean, maybe we can make a quick introduction to the most financial aspect of VCs, so which doesn't give, by the way, a good idea of our daily job, but we give a good idea of the money flow. So ourselves, when you've got a 100 million fund, this money comes from somewhere, right? I mean, it looks pretty obvious. But
the central bank?
Yeah, exactly, public money. No, I mean, so this money that we invest in startup ourselves, it comes from somewhere, and this somewhere is called LPs, for limited partners. So they are the investors, the own investor of the VCs themselves. What you have to know is that typically out of a 100 million fund, you would have maybe 1% more or less that is committed by the VCs themselves. So it means all of us, we have to invest a small, a big amount of money for an individual, but small regarding the fund in the VC, and the 99% remaining will be coming from those limited partners. They can be individuals, rich entrepreneurs, for example. They can be public actors like BPI in France, or public investment bank in the countries, or European investment bank. They can be family offices. They can be institutionals. They can be pension funds. They can be many things. And those guys, they allocate some of their money to VCs to invest in startups. So we know the pain of fundraising, which not a lot of entrepreneurs know.
Cool.
But the asset manager, so the guy sitting on a lot of money like pension fund and everything, they invest only a small part of what they have in venture capital, because as we all know, venture capital is a risky business. And even though we always hear about the great story and great returns, if you take as a whole, as an asset class, if you speak financially, it's not the best ever. So it's risky. It can be really good, but it's risky. So usually they say, okay, of the 100% of the money we have to invest, we're going to allocate 5%, 10% to a really risky asset, which is venture capital. So within the venture world, it looks like a lot of money, but within the asset management world, venture capital is really a small part of it.
Cool. But for me, I think I spoke to one of the partners at Highland Capital Partners back probably 2 years ago, and he was saying how their first European fund in 2007 took them 3 years to close. I think that was a small enough fund too compared to what they've raised after that. But so Fasto, you raised a fund in Europe back in 1997. What was that like?
Well, I mean, very tough, obviously, because we had zero experience in this world. Actually, apart from a few funds and like Partech, who was around, but was a lot in the US. In Europe, people did not really know what venture capital meant. So being our first fund, we had actually like a spray and pray approach where we talked to hundreds of people, mainly individual, high net worth individual that were kind of, curious and intrigued by the fact that we were investing in the internet, which was a kind of a new buzzword and nobody really knew. Actually, there were no internet dedicated fund at the time in Europe. And so, the thing is, was really tough, and I can understand so, because we were all like convinced of our, ideas that the internet was going to be great, but at the end of the day, when you pitch for a fund, it's like asking money for a company you don't really know what you're going to do about. So, people actually look at you and, they really have to trust you. And in the case like we were, where we had no track record to sell, it was like, gut feeling similar to what, a business angel might have when they talk to a seed company raising 100K and pitching for their money, with the difference that, at least the company can pitch on an idea, where here we pitch on, intention to back people. So it's really tough.
And also it's not liquid. That is to say that it's not a liquid asset. So when you invest, when our LPs invest in our funds, they know that they are not going to see the money before 10 years. And I saw some like industry average, and usually it's more than 10 years. It can go up to 12 years. So, and usually finance people, they don't like unliquid asset, because if they need the money, they can't get it like in 2 months. They need to wait for the end of the fund. So that's a difficult asset class to sell.
And how does it work in terms of different LPs putting their money in? Do you have a lot of external pressures? Obviously, VCs have to be quite friendly, quite open to entrepreneurs. If you're quite harsh with one founder, that spreads to small kind of ecosystems. But have you got LPs knocking on the door constantly, looking to know how things are going?
It depends. First, you have two main kind, I would say, of LPs. You have corporate ones and purely financial one. So the purely financial one, you just do every year what is called a whatever LP event. So you're going to say, okay, we're going to give you an update on the portfolio. How much did we invest, and what is the so-called net asset value of the company, which is to say, what is the value of the company? But it's difficult to say because they're private companies, and until it didn't exit, it's difficult. But sometimes you also have corporate VCs. With those guys, when you raise the money, you can tell them, okay, give us some money, and we'll give you some insight to the ecosystem. Okay, first we'll give you the money back and more, but also you get some data points and some insight of what is happening. In that case, you need to have a closer relationship with them, tell them, okay, maybe you send them some newsletter, or this is a big trend we're seeing, and those kind of things.
Cool. And Boris, coming from both sides of the table, so you founded a company, exited a company, joined a VC, and are now investing in companies. As an entrepreneur pitching VCs, what have you what are your key learnings in terms of where you are now, and what would you tell yourself, I suppose, a few years back?
First key learning is very related to this conversation, is that if you understand the job of the VC and his incentive and what he has to deliver, then it's much more easy to understand, how you react to your company, because basically, ultimately, even if on a daily basis, the job of VC is more to understand a vision, to assess people, products, etc. Ultimately, he wants to deliver value to his LPs, because the thing that is underlying to all this, if you're not a performing VC fund, next time you will go and fundraise, your potential LPs will say, okay, but last time, our money was locked for 10 years and we didn't make any return. So
right.
I'm not sure I really want, even if you gave me insight and etc., I'm not sure I really want to go with this fund. I would rather go with this fund or this fund or this fund that is performing better. So each time, as an entrepreneur, you go and see a VC, what you have to keep in mind is that beyond the excitement, beyond the vision, behind the fit that the VC can have with the founder, with the product, etc., he has to believe that you can deliver some purely financial performance. And that's something I think that as an entrepreneur, I clearly didn't get when I was pitching VCs, and that many entrepreneurs, today still don't really get. They don't get the order also of magnitude of what a good performance is to a VC. Right. That is not like 2x or 3x or more like 10, 20, 30x. Which, by the way, is very funny when you have an entrepreneur, and I was typically like this 4 years ago, that pitch a VC and say, our biggest competitor has been acquired for 10 million. So, meaning that, it's amazing, it's awesome, you should back me. And for VC, whatever the valuation of investment, 10 million is not a big exit, so that's, for me, it's the biggest learning I had switching from entrepreneur to VC.
Cool. And so going back, so you're on Fund 6 now, is that right? I mean, does it get easier with time, or, I mean, how much of your time would you proportion to, LP relationships or pitching kind of?
Well, no, it's cyclical, because you might have different funds for different segments raised in a firm, but it's clearly that, you are on fundraising cycle every 4 years if you manage a single fund, so it's not that you spend all the time to talk to your LPs. Actually, it's important to keep them informed, as obviously. I share the view of, if there is a trend today, actually is a bit the one mentioned on the corporate investors, because I think that, in year 2000, and many corporates have tried to set up VC arm themselves, and most of them failed. So now they understood, I think, that building close relationship with a few fund managers can get them the same benefit, if not more, because they can get the same exposure to innovation and startups. They can possibly get also good financial returns, and they are not getting in trouble if they change their strategy 3 years down the line because the CEO has changed it. So I think that if I have to identify for fundraising in recent years and something which is really a new trend here to stay, is probably that one of corporate VCs.
Cool.
But raising money for the VC, just like raising money for the startup. When you're doing well, it's really easy. So and so raising your second fund or third fund, if your first one did well, it's really easy. If you say, okay, we invested in Uber and this and that, people are throwing money at you. Right. But it's the first one that is difficult to raise, and if you don't have amazing results, this is what is difficult. But when you have, the best way to market yourself for a good fundraise is to have good return. The thing is that it takes time. It's not like you don't see them after 2 or 3 years. So that's the difficulty.
And in terms of LPs' interaction with your portfolio companies, have you got many LPs that would look to participate in later rounds or meet with the companies and be hands-on, or what way does that work in each case?
Again, at Balderson, no, it's not really the case. But before that, I was in a smaller French fund.
French, right.
Yeah, where we had corporate LPs. And this time, they were keen to meet the companies that may be interesting for the business. And we were trying to open the doors within those large French corporations so that the startups could work with them. But it's always tricky because, as I always say, startups and big corporations, they don't live in the same space-time. So 6 months for a big corporation is nothing, and 6 months for a startup, they can go like this or go like that.
Right.
But I think it starts to change a bit. You know, I mean, it's back to the trend of corporate, more interested in VCs, more interested in startup. Also, there is the hype, but there is also, I think, really the realization that they have to get closer to startups. So, for example, we have more or less 20 big corporates that have invested in our various funds, and we have a guy whose full-time job is to do business development between our portfolio company, but also our deal flow and those 20 corporates. And at the beginning, to be really honest, I was a bit skeptical. You know, it looks like, okay, we'll pretend that we do that, but does it really have value? And so far, I've seen tremendous value in doing that. Either to get deal flow from the corporate, either to assess the startup we see from a specialist corporate perspective, either to foster, you know, really pure business development between the companies and our companies and the corporate. And also what is really great is that when I see a startup, and if they're doing something really interesting, but for some reason it's not something I want to invest in now, or we can't invest, or for some reason, I can propose them, you know, to meet with my colleague and to foster a relationship with one or two corporates that are super happy, at least in terms of understanding what happens, understanding the potential synergies. So I'm not sure how much, you know, clear value it creates in the short term, but I think in terms of relationship and understanding the ecosystem, it's getting better and better.
Yeah, no, I agree. I was in the same position as Boris when my colleague talked about this corporate investment from, and I was skeptical because I had seen it in the past not working well. But now I think I really changed my mind because I'm seeing that without being too invasive, of course, you cannot have those guys coming every day to you and harass your portfolio company. But both in terms of scouting is interesting for us to see, even if we don't share their view, the way corporate sees a startup in some space. It might be good for exit. It might is something to be taken into account, especially if those companies are selling to corporate. And also, you know, clearly post-investment, there might be some real business to be done between the startup and the corporate, and the startup itself alone, without our support, to get into the corporate at the right level might take, you know, months or years in order to get to the level required to speed up things. Whereas, you know, at least initially, then, you know, it's a fairly recent thing, but we will see in a few years. But at least recently, the people have they dedicated some senior resource within the corporate to these kind of projects, and, you know, they are really helping some of the startup to get access at the right level.
Cool. And in terms of the kind of, we're running out of time, but the future of venture in Europe, so we've got Balderton of about $2.5 billion under management dollars in and around there. Partech are on fund, many funds rolling. But there's a lot of, particularly where I'm based mostly in Berlin, there's a lot of VCs that have, new teams that have emerged from existing venture capital funds. You've got from Balderton Harry Briggs in London, for example, or from Partech Gabriel Matuszka's got Fly Ventures in Berlin. There's a kind of a new wave of new teams emerging that claim to be more nimble and have less kind of baggage, I suppose, to bring with them. In terms of the future of yourselves, do you guys see yourselves?
Yeah, no, I mean, we are investing every day in companies that, quote-unquote, disrupt everything, so we would be fool to think that we are not going to be disrupted. So you have all the crowdfunding, the syndicate and angel list. This is a new way of doing venture capital without raising a proper large fund. And after, you also have philosophy. If you listen to Fred Wilson, Union Square Venture, they're an amazing fund. They did some amazing investment, and they want to keep small fund, like around $150 million. And some other people say, no, we need to have large fund because we want to be able to do large tickets. So it's a question of philosophy of what do you want to be in the value chain. But it's for sure, like the larger your fund, the more difficult it is to return it because you need really big exit.
With Partech, you've got 3 tiers, right?
Yeah, but I would like to comment on the previous question. I think for sure we're getting disrupted right now, and I think part of the reason is because VCs were not to the standard that entrepreneurs expected them to be. You know, for a long time and still today, it's often super frustrating as an entrepreneur to pitch a VC. You know, it's difficult to get his attention, which makes sense. It's also the rules of the game, but it's difficult to get his attention. Often you don't feel so respected, you don't feel so understood, you know. You feel that at some point this guy acts as if he had the power and you're just one among 1,000, you know. And so I think part of the reason why there is a lot of small funds that are much more nimble, much more entrepreneur-friendly is that a lot of big funds in Europe, and probably in the US also, has not been really very entrepreneur-friendly, has been more with a financial mindset, you know, and entrepreneurs don't want to be backed by people with only a financial mindset. You need to have this, but you need to be able to understand who you're speaking to. So I think we like, I don't know if it's a fair comparison, but like the taxis and Uber, taxis in Paris at least, the incumbents also create sometimes, some of them create the condition to be disruptive themselves. So.
I think we're almost done, but if you got anything to add in terms of...
No, I mean, I think clearly there will be a continuous evolution. I don't think there is going to be, you know, something dramatic that is going to change the way things are being done. But clearly, you know, funds also evolve. Funds are made of people. People changes. You know, you have cycles of 10 years. You cannot expect me to be the same that I was like 20 years ago, or maybe be the same in 10 years, so, or my partner. So it's a clearly a healthy thing that, you know, if I can say anything, in the financial world, you know, all investors are clearly turned into the past. You know, if there is one thing, you know, we did better with our fund one that was returned 8 times, than in fund number 5. So, you know, and that was not the most obvious one to invest in. So clearly, you know, also for funds, the tougher it is to raise money, it might be the best of your life. So, you know, there is going to be a natural evolution of things, and the fact that new players comes, there is space for many people, actually, especially in countries where, you know, now, I mean, maybe London, Paris, are countries where, you know, you have multiple number of players, but, you know, in Portugal and Italy where I am, you know, the number of players is small, and clearly having more players is a good thing.
Cool. Sounds good.
Thank you very, very much. I was trying to climb up on stage to go. No, just stay, because people will want to make some questions, right? No, nobody ever raises arms. So
David,
if you want
David
to...
Shackleton over here.
Okay.
Okay.
There's one question over there.
So if you have had an LP who's committed capital, but when it comes to writing that check, the funds haven't been available, what happens then?
Yeah,
well, yeah, it's there are rules like for investor, you know, clearly not honoring a capital call most of the time means losing all your investment. So it's something that an investor in this space needs to know upfront, and, you know, be sure to set aside the money that is needed to honor the capital call. Of course, it happens because you might have people who have, you know, personal problem or they go bankrupt and, you know, they cannot honor it. But that's a bit the rule of the game.
Another question over there, I guess?
Maybe you should explain what is capital call.
Ah, okay, yes, yeah, maybe.
Because when we say we raise 100 million fund, we don't get 100 million straight.
Exactly. You know, people, if we have 100 million fund, you know, every investment, basically, we call the pro rata of that money to fund that investment. So it's not that the money gets deployed over 5 or 6 or 7 years in installment, but the people who are committing to it, they are committing to honor not only the first 10% who gets called immediately, but also, you know, the later 90% that will be called as they are needed.
Yeah.
There's another question.
What is the ideal type of founder profile that you like to invest in when looking into funding companies?
Great team, great market, great product. Now, I mean, it's a super hard. It's super hard not to be very generalist and, you know, very. We want skilled people, super smart, with a vision, cohesive, lean. I mean, you know, energy. I mean,
no, but the one thing I can say, I mean, after a while, at the beginning in this industry, I thought it was bullshit when everybody say we invest mostly in people. But the more I'm in it, the more I realize there is difference. The one thing, and it's an easy one to have. I mean, maybe I don't have it, but for entrepreneurs, it's ambition. You need to show a lot of ambition. And I know that Europeans were not as good as that as the American, and I'm like this. But down the road, I see that people with the most ambition succeed more than the other, and not because they're more smarter or because they have better technology, just because they have more ambition.
We only have time for one more question, so there's a tie.
Non, t'es pas d'accord.
I'm sorry.
I don't know if any of you is fundraising right now. I just want you to comment if how is the environment to fundraise right now from a VC perspective, from your investors? Is there a substantial change from, let's say, 2 years, 3 years ago?
I saw a statistic recently, I think my mic's gone, the average time to close a fund. There's 17 funds closed last quarter in Europe, and the average time, I think, was 22.9 months to a full close, which for me seems quite long, but I'm new to this. I don't know if you guys...
Yeah, it's a long process. Like, you need to speak with the investor at the beginning, so maybe we're going to raise soon. We'll come back to you, but here is a little teaser, and you need to build a relationship. So but how is the environment? I mean, a lot of funds have been raised recently in Europe, so a lot of money is available right now for entrepreneurs. But there is still a lot of people that want to invest in quote-unquote digital or technology. So there is a money available.
I think according to the European Venture Capital Association, about 31% of all funds into new European funds last year were government agencies too. So they're by far still the biggest funder of new funds.
Yeah, I think it's a great environment. Startups are still hype. You know, everybody wants to build a startup. So VC become also hype, and so investing in VC, you know, it's a chain also becomes very, very fashionable, you know. And as to, for example, the corporates, there is first this hype, but also the need. So I think corporates are more and more interested. In France, we have a BPI, that is a French public investment bank that gives a lot of money to VC firms. So I think from a French perspective, and even a European perspective, I feel like it's pretty easy, not easy, but it's pretty good to fundraise for a fund right now. At the same time, there are also a lot of competition between the funds, because when you are a corporate, you want to invest in Balderton, 360, and Partech at the same time, you know, so usually, so it also means you have to prove yourself, but I would say it's pretty a good time.
Well, thank you very much. It's over.
Yes,
I'm sorry.
guys.
I'm very, very sorry.
Thank you.
Thank you.
Cheers.